If you're looking to buy Fingermotion stock, then please keep watching this video because we're going to look at the company's recent news, the market reaction, and what are the technicals telling us. And more importantly, what is the best trading approach given the current circumstances. The market is still very volatile at the moment, so we should be always careful about the positions that we choose, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Fingermotion has been trading around $4.53, which is still right above the support level, stipulating that the bullish trend hasn't been stopped. But we can reasonably question its longevity in the short term and how far it might go before the pullback forces it below the trend line. The market has so far maintained an interest in the stock as one of the more actively traded and followed ones, because it can reach profitability in the short term, with an EPS that edges ever closer to break even. That is one of the key reasons why the stock has been trading at a much higher baseline with a market valuation of more than $200 million. The idea that most people have is that once it announces that it is now a profitable company, the share price may go up significantly from here onwards, much like what happened with Palantir. With that being said, let's take a look at the technicals. The trading volume of Fingermotion is currently around 540,000 shares, compared to the average volume of 870,000 shares. Over the previous 52 weeks period, the price fluctuated between $1.01 and $7.97. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there is enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal and breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be much higher than the average volume. The market cap of Fingermotion is currently at around $280 million, compared to the enterprise value of $52 million. As we compare the current price to the historical price fluctuation, the stock is 1% higher than the 1-month low, 14% higher than the 3-month low, and 350% higher than the 52 weeks low. On the options market, it often gives a hint on the market sentiment about where the price might go next. The implied volatility is currently around 132% versus a historical volatility of 166%. The put-call volume ratio is currently around 4%. It is normal for many stocks to tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 2.3 thousand contracts a day versus the 30-day average of 5.4 thousand. In terms of open interest, the most recent volume of open interest is 63,000 contracts versus the 30-day average of 69,000 contracts. In terms of the shareholder structure, institutional owners have about 1% of the outstanding shares. The biggest shareholders include BlackRock, Prime Capital, and iShares. So it's always good to see some institutional participation in the stock for the long-term participation because they tend to be more stable. They don't want to trade in and out very rapidly. But as we can see, with only 1% of ownership, this stock is still mostly considered as a speculation position and not exactly a long-term investment one. The current short interest is around 10% of the total float, and 53% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume comes out of the dark pools, it may suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. Overall, I believe that Fingermotion is a stock that is worth buying, especially considering how close they are to profitability and that the narrative has been building around. I do have some reserves though towards the timing of the entry, and I do believe that the stock may still need some pullbacks before it reaches a support region that we're actually comfortable with. For the time being, small batches of purchases might be the best way to go, with the larger portions of the allocation for later when the price retraces even further.